Welcome, everyone, to episode 2 of Top of Mind with Consilio Wealth. We are back again for another episode and some more information on what's going on in markets, economy, jobs. We've got a lot of stuff to cover today. And really our intent with our time together is to update all of you on all of the relevant things that are in the news in the past week or so. We read a lot. We digest a lot. We have a lot of internal conversations around everything related to finance. And so our hope for this podcast and video is that we can get all this in a digestible form for all of you so you don't actually have to read all the headlines. So to kick us off, so what's going on? What's in the news this week? And how I'm going to turn it over to you for top of mind items for this week.
Yeah, well, thanks, Chris, and again, everyone, for listening. We're watching basically everything that impacts inflation, whether it's going to sustain or, taper off and hopefully go back to normal eventually. The biggest things that are coming up are jobs, the amount of jobs available versus the amount of job seekers. We're seeing quite a bit of trends that are looking positive, but it's still pretty early. But the positive trends, which is unfortunate for people who are losing jobs, but the jobs gap could be shrinking, where there's still about 2 jobs available for every job seeker, which should be really flip-flop. So this should be the other way around for relatively sustainable and healthy business margins, things like that. So this morning actually, we saw the number of jobless claims go up. Again, bad news for the people that are jobless, but relatively good news for, from the inflation point of view. And we're also seeing, specifically in the tech sector, which, has the most impact on us, tech companies are the first to slow down hiring, rescind job offers, take down open job positions, and sometimes laying off or reassigning people. Ford today announced they were laying off 8,000 people to focus on electric vehicles. So a lot of it is shifting for now. I don't think we're going to see mass layoffs, hopefully, but we are seeing encouraging signs, which is generally bad news, right? Anyone losing their job is bad. It's just not good. But this is probably a good sign for what the Fed is considering, for the fight against inflation.
Just saw in the news yesterday, Google's pausing hiring for the next 2 weeks. They're reevaluating all the people that they have now, and potentially that means a reorg. They did say that any extended offers would not be rescinded, which is good, because I know that we've seen that in the news quite a bit in the last handful of weeks. Like, you get an offer, you quit your job, and all of a sudden you are jobless. That could be, I don't know how much of an impact that has, but that could be a slight uptick in the jobless claims. People that are sort of left with in nothing limbo, due to that. Yeah. But a number of companies have announced that. It's not just Google. Microsoft's come out and said that they're slowing and pausing hiring. Amazon has said the same thing. So Meta has obviously said that. And Zuckerberg even came out and said, hey, it's going to get tougher around here, which is sort of a way of forcing people out and trimming staff. So, big tech is definitely being more conservative now, given where the economy is.
Well, I saw about 40% of recent job switchers are considering switching again. I don't know if, I think the last time I mentioned that the game of musical chairs is eventually going to stop, and you're going to run out of seats to grab. Yeah. And I'm not discouraging, you going after your own well-being and, your family's well-being, but job switching might be a little bit more tight eventually. Yeah. We're not quite seeing it yet, but I would just be cautious if you're jumping industries, jobs, things like that, because it just might not be as plentiful as it was.
And something that's interesting, I mean, the word recession has been in the news a ton. I mean, in fact, I wish we could search that and say, how much has the R word been posted in this last handful of weeks. I shared this with you, Hao, but to share it with our audience, we all got together for a team event a couple of weeks ago, and we all flew in here to the Seattle area and connected. Well, I was taking a shuttle from the hotel back to my house here one evening, and the driver of the shuttle is this young kid, maybe on college break. He could drive, so he was at least that old. But anyway, we were just chatting, and all of a sudden the conversation turns, and he goes, something related to the economy. He's like, "Oh yeah, the recession we're about to go into." And I was like, "Wow, the recession we're about to go into, like that's a pretty good prediction." What? Tell me more. And he's like, "Well, it's just so obvious. You can't print money forever. It'll turn the economy into recession." And that is definitely an influenced by media comment, right? We all think that it's going to happen because we're reading about it every single day. And unfortunately, we live in a world where bad news travels faster than good news. We won't know until we're through it. Maybe we're in it now already, but could this be the recession that never happens because everybody thought it was going to happen, and then the opposite happens? I don't know.
Well, I was going to bring up the point about the media too. Kind of the interest in recession, interest in the economy has definitely gone up for a lot of financial blogs, including ours, and financial media, because recessions in recent memory have been super, super scary, right? 2020 totally. Was scary, and 2008 was scary, and I'm anecdotally reading comments about people saying this is worse than 2008. Let's just pump the brakes on that. I think there is a lot of media driven emotions here, and we've got to actually look at the data. And we see high inflation, but we still see healthy amounts of spending. Like, you can't have a recession when people are spending like they are. People in businesses.
Isn't that funny? The recession would have to reduce spending. 70% of the U.S. GDP is based on consumer spending. And so if consumers stop spending, not only would that, well, let me back up. If we do actually hit a recession and consumers stop spending, that might be the fastest way to solve our inflation problem. Because one of the reasons why inflation has been so high is because people keep buying stuff. So there's no reason to lower prices. There's huge demand for used cars. There's huge demand for new cars. There's huge demand for kind of everything. And so it's okay to charge more. So
well, the feeling I get with spending is like, well, let everyone else slow down spending. I'm still going to go on my vacations, still go to Europe, still go to Disneyland, and we'll let everyone else slow down their spending. But if you've been to an airport recently, everyone's traveling.
It's busy.
Busy. Yeah. So again, unfortunately, they're all contributing to higher prices everywhere. And that's how we fix things, is stop spending. But stop spending means we might hit a recession, but again, it's not the American way, as crude as that sounds. I don't think there's it's a way to, it's very easy to get Americans to spend less.
Yeah. Well, and if we do, or if we're already in it, that would lower prices faster, right? We talk about this soft landing, hard landing with the Fed, and how the Fed's trying to kind of land the plane nicely. And that could take a lot longer to pull inflation down and get things back to some sense of normalcy. If we were to hit that sooner, gosh, maybe our problems go away faster. So, we don't know the answer here, but there are certainly two outcomes, and one of those two will happen, and only hindsight in the future will let us know what the right thing, what actually happened.
Again, take note of who's saying doom and gloom. When things turn out well, they're going to say, "Oh, I told you so. Things are great." It's just there's no accountability for what these prognosticators say, right? There's no ownership of it, because they just keep tweeting or keep posting and flood content with positive news, and that's essentially what sentiment is, right? They just kind of go with the flow with what the market's doing, but by that time, it's either too late to go defensive or too late to go offensive, right? The market's a lot faster than a lot of people realize.
All right, so let's move on. So this chart's from Goldman Sachs. So Goldman, this is July 8th. They sent out a chart that shows historical bottom. So, where are we, right? What's the median pullback? Where are we as of today? The median pullback in historical bottoms of historical U.S. recessions is 21.6% as of June 2022, when they posted this chart about a week ago. S&P 500 is down about 23.6. So a little bit beyond that. And yes, it's been worse than that. And yes, it's been less than that. But, I think one of the questions is, if there's more bad news, does that actually mean markets continue to go down? Historically speaking, bad news doesn't necessarily dictate market movements. In fact, for no reason, markets decide to V and go back the other way. Might be dating back a little bit far, but March 9th of 2009 was the bottom of the great financial crisis. There was absolutely no good news that day, that week, that month, even for about 6 months there. But the market rocketed forward after that day for whatever reason. So this data, I think, helps us say we're down a good amount. It doesn't necessarily mean we've hit bottom, but it does mean that likely things do turn around, here at some point into the future.
Yeah, and again, we use the charts not to time the bottom, but just to kind of get context of where we were or where we are, right, relative to other points in history, right? The chart shows 1990, 82, 80, 74, and anyone who follows market history, those are just recession dates, right? Or have been followed by recession. Again, timing the bottom, it's something we don't recommend. It's something that it's very difficult to do because it requires being able to read the future. And I know exactly 0 people who could do that with 100% accuracy.
Yeah, no kidding. All right, so a couple of other headlines here. Freight prices are finally coming down. That's a good thing. So supply chain is starting to ease. Cost of shipping goods is coming down. Gas prices have also eased a bit recently here. But that's all really good news for the future inflation prints that are coming out.
Yeah, well, again, it's suddenly costing less, or it's costing the normal rate to ship something across the world or the United States, right? So we're seeing early in the year, late 2021, early 2022, where shipping costs have nearly tripled because shipping companies knew that they were in high demand, and they priced their goods or they priced their services just to react, right? Everyone wanted to ship everything. It's because retail therapy was a big thing in 2021, where we did have vaccines, but they were still limited supply, right? How do you vaccinate 330 million people and a third of them are resistant, to getting the vaccine, not resistant to anything? They're just don't want to get the vaccine. So, the reopening had been a lot slower than we anticipated, which could have been a good thing. But what that caused is people staying in and buying, right? Buying couches, buying appliances, buying TVs. And what that's doing is it has an impact on the demand of what Walmart sees, right? Walmart sees Chris wants to buy 10 TVs. We need to order 20 TVs to satiate his demand. But that's just Walmart. Look at Costco, look at Best Buy, look at Target. They're all doing the same thing because we have this massive influx of demand for specific durable goods. And this creates a bullwhip effect. So if you imagine like Indiana Jones whipping his bullwhip, you'll see that towards the hand there's small ripple, but as you go towards the end of the whip, it cracks, right?
Yep.
So the first end of the whip is customers, next is retailers, right? I described Walmart, Target, but beyond that is manufacturers, the people who put the washer dryers together, right? They're getting orders from not me and you, but they're getting orders from Target, Walmart, Costco, in the thousands, hundreds of thousands of orders, right, to satiate this demand that everyone assumes is going to happen in perpetuity, meaning Chris is going to buy washers and dryers forever, and he's going to buy it at a much higher rate than 2019 forever, right? And manufacturers like Whirlpool, GE, Samsung are making and producing goods at a much higher level than they're used to. And then going downstream more or upstream in their suppliers, you're looking at people who are creating steel, aluminum parts, computer chips, right? Everyone knows what's going on with cars. Those suppliers, like the raw suppliers, are experiencing probably the biggest effect because all the GEs, all the Samsungs are over ordering basically to be able to produce the goods to put in Target stores to satiate Chris's need to buy and buy and buy.
Yeah.
What they didn't anticipate though is how much time it takes to build all that and how quickly Chris decides he doesn't want a TV or a washer dryer anymore. He's going to go on vacation. So that multiply that by millions of people in America, and now we have an over inventory problem, right? My wife went to Target, and the toy aisle, there's a whole aisle now of 70% off clearance. Right? Toys won't be measurable in inflation because they're such a small dollar item.
Yeah.
But we're seeing it with toys. We're seeing it with large appliances because these stores simply have no room. And if they underorder, though, we can probably experience another 2021. So you have to moderate this. And I think the issue is over ordering in the first place. And that's why things were so tight and took forever to get. It's because everyone over ordered at the very same time.
I sent you a text on this, but a couple weeks ago, I got that Costco booklet, that we all get in the mail that says, here's the things that are coming in on sale. And I took note to glance through it to see what big items were on sale. And lo and behold, appliances, right? Washers, dryers, cooktops, all these things were hundreds of dollars off. And then you keep kind of flipping, and all the normal things were $4 off, $6 off. You can get almonds for $6 off, or you can get, power bars or something for a discount. So it's like, okay, you have the normal things, and then you have all these big giant things that really take up a ton of space in a Costco.
Yeah, space. Yeah.
But ultimately don't have that great of a profitability because of all that space. We've talked in the past of imagine a pallet of almond butter, right? Or some sort of a your favorite nut butter, right?
It's a tiny jar.
It's a tight jar, yeah. And it might be $12 or $15, and there might be, 12 of those per flat, and then think about how many are on a whole pallet. I should have done the math before we jumped on this call, but there's a lot of money sitting on that pallet for no wasted airspace. And exchange that with, say, a washer and a dryer combo that maybe fits on that same pallet. I have to think there's probably more than $1,500 of almond butter sitting on that pallet than there is this appliance, right? So, that's the issue that a lot of these retailers are running into. And earnings came out then for Target, for Walmart, for Costco. Everybody is saying, and Amazon as well, everybody's saying we have too much, expect big discounts. So if you're in the market for appliances or big things, just wait a little bit. We think they're going to go on sale. We think wait a couple months and do some price shopping because there's too much, and you can take advantage of that at a lower price, mind you, which will maybe help inflation a little bit.
Yeah, and we've been challenged on this where, again, we understand the experience of going to a Target. There are some empty shelves, depending on where you look. Like if you're looking at particular home goods, baby formula is a big one. I know,
still shortage.
Chris, you're probably living through this now, right? There's going to be shortages in the other higher demand or the biggest issue is lower supply. You're going to see some empty shelf space. So by us saying this, you have to be careful where you're looking, right? We're suggesting bulky home goods, right? And that's exactly what was over ordered because everyone was remodeling their homes. And guess what? Everyone's leaving their homes to go on vacation. The remodeling demand has gone way down.
So switching gears a little bit, gas prices are down for 30 straight days or more now. This is a week old or so, this article here. So that's good. I don't know if you all have noticed that. If you're anything like me, you have become an exclusive Costco gas fill-up person. because now that savings is actually a lot more. So that's all of where I go now. And I was really excited. I filled up, I don't know, this last weekend or something. I want to say it was like $5.05 a gallon. I was like, oh, awesome. But it was still over $70 to fill the tank. And when it got over 70, it kind of stung a little bit. So I'm still holding out. I'd like to see it under $70, but hey, last 30 days of declines, it's going the right direction. So that's good news.
Yeah, a couple of things with that is it's not all great news, yes, to your pocketbook, but there's a reason for lower demand, right? China is probably going to be in a recession for a while. They have a zero COVID policy, and China is one of the world's biggest users of gas. Other transports, right? We saw shipping is cheaper, right? And because demand for shipping has gone down. Unfortunately, with all the vacationing, we have fewer flights available because we have fewer pilots, right? Airlines have been, managing this influx as well as retail stores, right? Where they shed all of their pilots in 2020, only to find that they can't get them all back in 2021 and 2022.
Yeah.
And we've all read about, canceled flights, canceled connections. And I think they're finally adjusting by simply offering less available routes, which lowers demand for oil as well because you're flying less. You're charging more, but you're probably flying less. So all not great news. We still have a war in Russia, Ukraine, where, the world supply of oil is crimped, but it's rerouted, right? Who's buying the Russian oil? It's India, it's China. And
a little bit Europe now, I just saw in the news.
Yeah, Europe got
a little bit.
Got their pipelines reopened.
Yeah.
So, but that's because there's oil suppliers from South America and Middle East and North America. Again, oil's fungible. Russian oil, to me, is the same as American oil if you kind of strip out the humanitarian part of it. But
sure.
Oil is oil.
Same product. Yeah. So let's talk a little bit about dollar strength. It was all over the news a handful of days ago that the euro and the dollar have hit parity for the first time in 20 years. So what does it mean? Why is it happening? And why is the dollar so strong right now?
Let's go to the math problem of it, where the U.S. central bank, the Fed, is the most aggressive in raising rates. So simply, if you have U.S. dollars in a bank, you're getting the highest interest return for cash. You're probably going to get 1% from your actual bank, but if you put your money in T-bills, things like that, you're going to get, maybe 3%. And where are you going to get any of that in the rest of the world? So a strong dollar, I know some of the same prognosticators saying we're in recession, saying the dollar's going to weaken. They were right. If you were looking at a 70s style inflation, in the 70s, the dollar was extremely weak. Now the dollar is historically strong. The reason why is our central bank has raised rates faster than every other central bank, right? The Bank of the European Central Bank raised their rates today by 0.5%, like 0.5%, which is a huge jump. So we might see some of the divergence back to normal, meaning the euro trades at a relative premium to the dollar. But this is happening because everyone else is in danger of recession too, and their currency is weakening. And a lot of foreign investors are funneling their safe haven assets over to us, our treasuries, right, and our government debt, right, which is strengthening the dollar.
Which also has downward pressure on interest rates.
Yes.
Right? We were talking about this earlier, so this is kind of interesting. Let's say that investors are buying 10-year bonds. If there's a ton of people that show up to that auction and buy all those bonds, the interest required to get that buyer to buy is less because there's so much demand. Versus if there's one person in the room buying, they could just say, nah, I don't want it yet. Nah, I don't want it yet. And the price actually floats up. And so this is sort of a interesting, it's inverse, right? You think, stocks or markets that have a lot of demand that sometimes can push prices up. This is actually the opposite of that.
Yeah, higher prices or higher demand in bonds actually brings the yields down, right? And we're seeing outsized demand for the 10-year. We're speaking of the U.S. Treasury here, where there's no credit risk. It's because of that, because the U.S. has never defaulted on its debt. That's why it's considered a global safe haven. And the dollar is strong. And just bringing an example, Microsoft does business overseas. And if they're bringing in revenue in euros, when Microsoft brings in those euros, what do they have to do? They got to convert those euros back to the U.S. dollars.
Yeah.
That hurts Microsoft as well because they're having to spend more euros to get relative U.S. dollars. So strong. The term strong is a kind of a misnomer. Strong doesn't really mean you're better or worse off than anyone else. It just means relative to other currencies. But there's real drawbacks for a strong dollar, right? So if you're an exporter and I'm manufacturing washer dryers and I need to ship them over to Europe, that European customer has to pay more. They're probably not going to buy my US based washer dryer because it's more expensive now, right? So this could be recessionary in terms of like the technicality of it, where the more we import, because it's cheaper to import goods now, right? Every other currency is cheaper, so yeah, buy more of everything else. But the reverse stings us too, where if we're exporting goods, it's not good for us because it's relatively more expensive. And
It's actually super. Yeah, sorry, keep going.
Yeah, well, go ahead.
It's super interesting that if you really put together what we've been talking about here, and I'm just thinking about it. So we have a stronger dollar, which means countries that are exporting to us, that's not as good for them. But we have shipping costs that have come down. We have oil costs that have come down. We have supply chain that has kind of eased a little bit. So those costs have come down. So it's like, I can't help but wonder, since some costs have gone down, but exchange rates have gone the other direction for exporting countries to the US, is it still better? Like, does it still net as a better bottom line relative to where it was? I haven't seen that analysis yet. I'm just thinking through our conversation today, but that's got to be interesting on how that math actually works out.
Yeah, there's certain offsets, but we won't know until probably the fourth quarter reporting. So we're just now reporting in second quarter, so we won't know the effects of all this currency movement for quite a few quarters.
Yeah, so much of this stuff is lagged. Yeah. It's lagged, right? And inflation numbers come out, and I was just reading about this. Inflation comes out and it printed higher than it has, the last time, right? It keeps going up. Oh my God. And then there was a counter article that said, well, wait a minute, this is historical data. We're already seeing the housing market cool off. We're seeing home prices are coming down. So a lot of, these are actually good things of sort of slowing. So the article was saying, well, is the Fed acting too quickly? Like, has their job already been done and our prices actually coming down? And I think that's the greatest challenge that all the policymakers have is what data, you can't really look at it in real time. Oh, homes are sitting for now 2 weeks instead of 2 days. So we did it. We got, we're successful. Like, that's not the only barometer. But at the same time, we feel like things are moving so fast now. When you have data that's 30 days or 60-day lag, it feels like it's too slow. Yeah.
The last inflation reading, right? It was a scary reading, 9.1.
Yeah.
But that was June's reading. Gas prices have crashed in July. So if we're going to live and die by the fluctuation in gas movement, we're going to expect to see a really low inflation reading in August, which, again, inflation didn't go away in August. Everyone needs to stop focusing on headlines here.
So interest rates have obviously come up. They've come down a little bit recently, but that's affected the housing market. And there was this article that I pulled. 2 apartment buildings sold here in the Seattle area. One's in Issaquah and one's in Kirkland. And get this, the one in Issaquah sold for an average of $768,000 per unit. I don't believe that was a record. I think it was just under the record, which was set in Seattle last year at a building kind of next to where Amazon's headquarters is in South Lake Union. The other building was in Kirkland, just under $600,000 per unit. These are rentals. And so you have to wonder, these investors are buying these buildings presumably because rents keep going up. And so the thought process is, well, if we can buy this building, even if we're financing it 5 or 6%,
we can bring up rent. Yeah.
We can bring up rent, and rents have gone up, and therefore this is worth that much. I'm just alarmed that an apartment is worth $768,000, and that, an investor says I can rent that and make money. That's wow.
Yeah. I have no comparable, number in my head where is that a lot relative to what we've seen in apartment buildings that size and that, that location. But just broadening it out, like Redfin just released a report of the fastest cooling markets, and Seattle's like number 5. And here in Sacramento, we're number 2. And on the top 5 list, that the commonality between those cities is they're near tech hubs or have benefited from the tech boom. And it kind of makes sense, right? If tech is generally slowing down new hiring, there's less people relocating or needing to relocate, at least for a job, into that area for now.
And it's also, and Bloomberg reported this, but are we ever going to be out of this housing crisis? We aren't building fast enough. And I had heard this years ago. This was, gosh, it was near the financial crisis. Because housing virtually stopped, right? But just because of the demand of new home buyers and from what we're knocking down just due to old age, we were still creating a shortage based on what we were building. And so it's like, well, are we ever actually going to be out of this? We're still having that problem. We're not building enough for the demand. So yeah, housing has slowed, but it's not like we're getting to the place where we have an oversupply by any means. Again, we'll just have to see. I mean, none of us have an answer to this, but it's just interesting.
Well, it's a conundrum with housing, right? It's slow to rebuild after the big crash when rates are low, but now rates are high. There's less incentive for home builders because they generally are debt operated, right? They operate in cheap debt, and like mortgage takers, right, who are paying nearly 6%. There's a common effect to home builders, which is unfortunate. Like I don't think there's an easy way out of this.
All right, a couple other things on interest rates, and we'll shift to commodities prices. Some good news there, and we'll wrap up. So the other piece that hit the news recently: Amazon pauses some of their Bellevue towers as they reevaluate footprint. Head fake or real news? I don't know. We won't know until later on. But my thought is they come out and they say, "Hey, we're building a ton in Bellevue." The news said that they were reevaluating the design of the buildings because they have more of a flexible work now. Maybe they don't need individual offices. They need more like hoteling type style. So they were redoing the design. But they still said they were committed to hiring, as many people. Again, head fake, as in we don't need this much space actually. And everybody's going to be at home and sometimes in the office. Or is this in fact true that they're just redoing design? Just wanted to point it out. Thought it was interesting and in the news and affects the greater Seattle area as well.
Yeah.
Next item here. Individuals have never paid more for cars. Cars are getting more expensive, in part because of inflation, but also because of financing. And there's a chart here that shows average monthly car loan payments in 2021. So this goes up a little bit every year, as you would imagine. In 2021, average new car payment about $575 a month. Average used car payment about $475 a month. Interesting. Seems like it'd be less than that. But anyway, just reading what I'm seeing. Today, average new car payment, almost $700, and average new car payment, almost $550. There are more cars today that are over $1,000 a month. 12.7%, in fact, of cars, according to the Wall Street Journal, are now $1,000 a month payment.
It seems like everyone's on this. Well, again, car sales, it's about 4 million short of what a normal year would be. Normally, we'd sell about 17 million cars. Right now, it's 13 million. It's not because of lack of demand. All right. Chris just said there's plenty of people willing to pay those high monthly car payments. We simply just can't manufacture that many cars now.
Yeah.
Again, I think the automotive industry looks like it's going to be the slowest to recover from this this supply chain bottleneck, because it looks like semiconductors are sitting on a bit of a surplus, which is really odd to hear.
Oh, interesting.
But automakers are still quoting, "Hey, lack of chips." So who's lying here?
Two potentially good news items. Prime Day sales were the biggest ever, at least according to one press release. We'll see the full numbers when Amazon releases earnings, I believe later this week. And last piece of good news, Costco is not raising the price of the famous $1.50 hot dog combo. The CEO had one answer to that when asked on the earnings call, will you raise the price due to inflation? And his answer was no. So, hey, good news there.
Well, if I'm Costco, I'm probably raising the price of membership and not hot dogs. So
yeah,
again,
and everything else on the menu.
Play here. Yeah.
Totally. Yeah, exactly. Okay, you have a couple interesting items here on inflation, commodities prices, and then average investor returns, which I was alarmed when you sent this over to me, and then let's wrap up.
Yeah. Playing on the bullwhip effect, that we're seeing commodities come sharply down. It's because all the over ordering has leveled off or suddenly become under ordering, right? So we're seeing corn from its peak, down 30%. Copper from its peak down 46%. Coffee's down 13% year to date.
By the way, does anybody ever notice that the price of coffee changes like at Starbucks? Because I definitely don't, even though I hear in the news all the time that coffee prices move around like crazy.
Yeah, I don't.
Like, you go to the store for other things, and it moves, like, oh, something's $2.99 one week, and then it's $3.29, but gas, like, perfect example. But you go to Starbucks, and the price of the latte is always the same. I don't understand. Anyway, keep going.
Well,
it's just
maybe
one of those things.
Costco should start posting their coffee prices on like billboards, like
the
gas
spot price.
Yeah, where everyone
gas,
should.
coffee, orange juice. Can you imagine if all these things actually moved, like milk?
Yeah.
You'd have people grabbing it and running up to the. Oh, it's cheaper now.
Well,
Silly.
my Facebook feed would be full of pictures of orange juice and milk prices, like it is with gas and temperature here. All right. So expectations. I think expectations are everything. We have a chart from our partners at Natixis where retail investors have an outlook, right? What do they think they're going to get for performance for over the next few years, and versus financial professionals across the globe? Actually, this survey measures Argentina all the way up to the UK and the US and everything in between, and the financial professionals across the globe, right? Their expected returns are 5% roughly on average. And if we go to their retail investors in all those countries, right, we're looking at a probably average of 13-14% returns. So the professionals are saying, hey, tone down some of the expectations. 5% returns, actually not the worst returns in the world. Like we kind of based a lot of our plans on a lower rate for to be conservative and to build in some buffer here. Investors have just an outsized expectation of returns, right? Because if everyone's making 15%, that's inflationary, right? And everyone's expectations to beat the market, to beat their financial professionals, you're going to budget off that. You're going to budget off what you think you're going to make, have in 10 years. And if you're unrealistic about your expectations, you're going to overspend now, or you're going to undersave now. And that's such a dangerous combination where, you don't get those 10 years back. And if your expectations are out of line with reality, right, you're setting yourself up for something you can't take back, if that makes sense. Like
it's the FOMO issue, right? Like, I expected 20%, but I only got 10. That stock over there did 20, so I got to go buy that one. I mean, you'd be cannibalizing your own returns.
Yeah, who cares what the other stock did? Like, who cares what the benchmark did? Like, look at your own benchmark. What is your financial plan?
What's your financial plan say? Yeah, we say that all the time.
Yeah, and if it says 12%, returns year over year, I think you're in trouble. You're not saving enough or you're spending too much.
I was just alarmed to see this when people are asked what they think, the market should give them every year, 17.5% here in the U.S. and, financial professionals 6.7. We run our plans at 7 and change during working years and then 5 in retirement. And, after reading this, I can definitely see when we explain this to certain folks and it's like, ho hum, I can do better than that, right? And it's like, look, I hope you can. But the reality is if you zoom out long enough, it does about 7, 8, 9-ish long term. And so I think that investors are open for going to have a rude awakening here when the market likely doesn't give them 17 or 18 or 20% for the next number of years, like it has over the last 3. We've been in a really unique environment.
Yeah, the first episode is like save as if the worst is going to happen, but be optimistic as if the best is going to happen. This survey tells me that you're doing the opposite, where if you're getting nearly 20% returns in the U.S. at 17.5 expectation, you're naturally going to save less in today's dollars.
Yeah.
Which is so dangerous for 2030, 2032, because you've wasted prime savings years, right? When the market's down, you probably want to save more, not expect more from your investments. That's just such a dangerous equation.
Yeah, like now. I mean, if you look at where the market is today and just draw backwards, you have the opportunity to invest at that price years ago with money that you didn't have years ago, because now the money is here today, as in paycheck lands and you can invest dollars from that paycheck, right? I mean, I think that's so powerful to just disconnect from the, oh my God, it's down, and connect with when you're well diversified long term, it does go the right direction. And today is essentially a buying opportunity. And that's not because we know where the bottom is, but it's off the top, and that's good. So that's, I think, the lesson in all of this is just stick to plan, keep buying, keep diversified.
Well, build a proper plan that's relatively conservative, right? Because if in the end you beat your plan, that's nothing but icing. But
we call that excess.
The risk
we like
is
that.
If you don't beat your plan, you're in really bad shape. And if you're a 65-year-old in bad shape, there's not a lot we can do because we can't reverse time. Yeah, we lose all that compounding. Yeah.
All right. So final headline is 70% of Americans think a recession is coming. Are you one of those? I'd be interested to hear. The media has definitely tried to tell us all that's going to happen. And like I continue to say, we won't know until we know. And staying diversified is what will get everybody through this. So of course we're proponents of that, but be curious to know.
Yeah, be thoughtful about it. Like, because if it's true, you're going to position your spending in your portfolio as if there's a recession. And if you're really not, then you probably don't think there's a recession. And again, we try to be diversified for that reason, because we don't know until after the fact.
Exactly. Okay. Awesome. Well, this was fun.
Yeah.
Excited for our next time. We will bring more updated content in the next recording here. And if anybody has questions, feel free to reach out and we will answer them here live on our next recording.